53. An entity shall estimate an amount of variable consideration by using either of the following methods, depending on which method the entity expects to better predict the amount of consideration to which it will be entitled. A. The expected value. The expected value is the sum of probability-weighted amounts in a range of possible consideration amounts. An expected value may be an appropriate estimate of the amount of variable consideration if an entity has a large number of contracts with similar characteristics. B. The most likely amount. The most likely amount is the single most likely amount in a range of possible consideration amounts, i.e. the single most likely outcome of the contract. The most likely amount may be an appropriate estimate of the amount of variable consideration if the contract has only two possible outcomes. For example, an entity either achieves a performance bonus or does not. 54. An entity shall apply one method consistently throughout the contract when estimating the effect of an uncertainty on an amount of variable consideration to which the entity will be entitled. In addition, an entity shall consider all the information, historical, current and forecast, that is reasonably available to the entity and shall identify a reasonable number of possible consideration amounts. The information that an entity uses to estimate the amount of variable consideration would typically be similar to the information that the entity's management uses during the bid and proposal process and in establishing prices for promised goods or services. Refund liabilities. 55. An entity shall recognize a refund liability if the entity receives consideration from a customer and expects to refund some or all of that consideration to the customer. A refund liability is measured at the amount of consideration received or receivable, for which the entity does not expect to be entitled, i.e. amounts not included in the transaction price. The refund liability and corresponding change in the transaction price and therefore the contract liability shall be updated at the end of each reporting period for changes in circumstances. To account for a refund liability relating to a sale with a right of return, an entity shall apply the guidance in paragraphs B20 EB27, constraining estimates of variable consideration. 56. An entity shall include in the transaction price some or all of an amount of variable consideration estimated in accordance with paragraph 53 only to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty associated with the variable consideration is subsequently resolved. 57. In assessing whether it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur once the uncertainty related to the variable consideration is subsequently resolved, an entity shall consider both the likelihood and the magnitude of the revenue reversal. Factors that could increase the likelihood or the magnitude of a revenue reversal include, but are not limited to, any of the following. A. The amount of consideration is highly susceptible to factors outside the entity's influence. Those factors may include volatility in a market, the judgment or actions of third parties, weather conditions and a high risk of obsolescence of the promised good or service. B. The uncertainty about the amount of consideration is not expected to be resolved for a long period of time. C. The entity's experience or other evidence, with similar types of contracts is limited, or that experience or other evidence has limited predictive value. D. The entity has a practice of either offering a broad range of price concessions or changing the payment terms and conditions of similar contracts in similar circumstances. E. The contract has a large number and broad range of possible consideration amounts. 58. An entity shall apply paragraph B63 to account for consideration in the form of a sales-based or usage-based royalty that is promised in exchange for a license of intellectual property. Reassessment of variable consideration. 59. At the end of each reporting period, an entity shall update the estimated transaction price, including updating its assessment of whether an estimate of variable consideration is constrained, to represent faithfully the circumstances present at the end of the reporting period and the changes in circumstances during the reporting period. The entity shall account for changes in the transaction price in accordance with paragraphs 87 to 90. The existence of a significant financing component in the contract. 60. In determining the transaction price, an entity shall adjust the promised amount of consideration for the effects of the time value of money if the timing of payments agreed to by the parties to the contract, either explicitly or implicitly, provides the customer or the entity with a significant benefit of financing the transfer of goods or services to the customer. In those circumstances, the contract contains a significant financing component. A significant financing component may exist regardless of whether the promise of financing is explicitly stated in the contract or implied by the payment terms agreed to by the parties to the contract. 61. The objective when adjusting the promised amount of consideration for a significant financing component is for an entity to recognize revenue at an amount that reflects the price that a customer would have paid for the promised goods or services if the customer had paid cash for those goods or services when or as they transfer to the customer, i.e. the cash selling price. An entity shall consider all relevant facts and circumstances in assessing whether a contract contains a financing component and whether that financing component is significant to the contract, including both of the following. A. The difference, if any, between the amount of promised consideration and the cash selling price of the promised goods or services, and B. The combined effect of both of the following. I. The expected length of time between when the entity transfers the promised goods or services to the customer and when the customer pays for those goods or services, and 2. The prevailing interest rates in the relevant market. 62. Notwithstanding the assessment in paragraph 61, a contract with a customer would not have a significant financing component if any of the following factors exist. A. The customer paid for the goods or services in advance and the timing of the transfer of those goods or services is at the discretion of the customer. B. A substantial amount of the consideration promised by the customer is variable and the amount or timing of that consideration varies on the basis of the occurrence or non-occurrence of a future event that is not substantially within the control of the customer or the entity, for example, if the consideration is a sales-based royalty. C. The difference between the promised consideration and the cash selling price of the good or service, as described in paragraph 61, arises for reasons other than the provision of finance to either the customer or the entity, and the difference between those amounts is proportional to the reason for the difference. For example, the payment terms might provide the entity or the customer with protection from the other party failing to adequately complete some or all of its obligations under the contract. 63. As a practical expedient, an entity need not adjust the promised amount of consideration for the effects of a significant financing component if the entity expects, at contract inception, that the period between when the entity transfers a promised good or service to a customer and when the customer pays for that good or service will be 1 year or less. 64. To meet the objective in paragraph 61 when adjusting the promised amount of consideration for a significant financing component, an entity shall use the discount rate that would be reflected in a separate financing transaction between the entity and its customer at contract inception. That rate would reflect the credit characteristics of the party receiving financing in the contract, as well as any collateral or security provided by the customer or the entity, including assets transferred in the contract. An entity may be able to determine that rate by identifying the rate that discounts the nominal amount of the promised consideration to the price that the customer would pay in cash for the goods or services when or as they transfer to the customer. After contract inception, an entity shall not update the discount rate for changes in interest rates or other circumstances, such as a change in the assessment of the customer's credit risk. 65. An entity shall present the effects of financing, interest revenue or interest expense, separately from revenue from contracts with customers in the statement of comprehensive income. Interest revenue or interest expense is recognized only to the extent that a contract asset, or receivable, or a contract liability is recognized in accounting for a contract with a customer. Non-cash consideration. 66. To determine the transaction price for contracts in which a customer promises consideration in a form other than cash, an entity shall measure the non-cash consideration, or promise of non-cash consideration, at fair value. 67. If an entity cannot reasonably estimate the fair value of the non-cash consideration, the entity shall measure the consideration indirectly by reference to the standalone selling price of the goods or services promised to the customer, or class of customer, in exchange for the consideration. 68. The fair value of the non-cash consideration may vary because of the form of the consideration, for example, a change in the price of a share to which an entity is entitled to receive from a customer. If the fair value of the non-cash consideration promised by a customer varies for reasons other than only the form of the consideration, for example, the fair value could vary because of the entity's performance, an entity shall apply the requirements in paragraphs 56 to 58. 69. If a customer contributes goods or services, for example, materials, equipment or labor, to facilitate an entity's fulfillment of the contract, the entity shall assess whether it obtains control of those contributed goods or services. If so, the entity shall account for the contributed goods or services as non-cash consideration received from the customer. Consideration payable to a customer. 70. Consideration payable to a customer includes cash amounts that an entity pays or expects to pay to the customer, or to other parties that purchase the entity's goods or services from the customer. Consideration payable to a customer also includes credit or other items, for example a coupon or voucher, that can be applied against amounts owed to the entity, or to other parties that purchase the entity's goods or services from the customer. An entity shall account for consideration payable to a customer as a reduction of the transaction price and therefore of revenue unless the payment to the customer is in exchange for a distinct good or service, as described in paragraphs 26 to 30, that the customer transfers to the entity. If the consideration payable to a customer includes a variable amount, an entity shall estimate the transaction price, including assessing whether the estimate of variable consideration is constrained, in accordance with paragraphs 50 to 58. 71. If consideration payable to a customer is a payment for a distinct good or service from the customer, then an entity shall account for the purchase of the good or service in the same way that it accounts for other purchases from suppliers. If the amount of consideration payable to the customer exceeds the fair value of the distinct good or service that the entity receives from the customer, then the entity shall account for such an excess as a reduction of the transaction price. If the entity cannot reasonably estimate the fair value of the good or service received from the customer, it shall account for all of the consideration payable to the customer as a reduction of the transaction price. 72. Accordingly, if consideration payable to a customer is accounted for as a reduction of the transaction price, an entity shall recognize the reduction of revenue when or as the later of either of the following events occurs. A. The entity recognizes revenue for the transfer of the related goods or services to the customer, and B. The entity pays or promises to pay the consideration, even if the payment is conditional on a future event. That promise might be implied by the entity's customary business practices. Allocating the transaction price to performance obligations. 73. The objective when allocating the transaction price is for an entity to allocate the transaction price to each performance obligation, or distinct good or service, in an amount that depicts the amount of consideration to which the entity expects to be entitled in exchange for transferring the promised goods or services to the customer. 74. To meet the allocation objective, an entity shall allocate the transaction price to each performance obligation identified in the contract on a relative standalone selling price basis in accordance with paragraphs 76 to 80, except as specified in paragraphs 81 to 83 for allocating discounts, and paragraphs 84 to 86 for allocating consideration that includes variable amounts. 75. Paragraphs 76 to 86 do not apply if a contract has only one performance obligation. However, paragraphs 84 to 86 may apply if an entity promises to transfer a series of distinct goods or services identified as a single performance obligation in accordance with paragraph 22b, and the promised consideration includes variable amounts. Allocation based on standalone selling prices. 76. To allocate the transaction price to each performance obligation on a relative standalone selling price basis, an entity shall determine the standalone selling price at contract inception of the distinct good or service underlying each performance obligation in the contract and allocate the transaction price in proportion to those standalone selling prices. 77. The standalone selling price is the price at which an entity would sell a promised good or service separately to a customer. The best evidence of a standalone selling price is the observable price of a good or service when the entity sells that good or service separately in similar circumstances and to similar customers. A contractually stated price or a list price for a good or service may be, but shall not be presumed to be, the standalone selling price of that good or service. 78. If a standalone selling price is not directly observable, an entity shall estimate the standalone selling price at an amount that would result in the allocation of the transaction price meeting the allocation objective in paragraph 73. When estimating a standalone selling price, an entity shall consider all information, including market conditions, entity-specific factors and information about the customer or class of customer, that is reasonably available to the entity. In doing so, an entity shall maximize the use of observable inputs and apply estimation methods consistently in similar circumstances. 79. Suitable methods for estimating the standalone selling price of a good or service include, but are not limited to, the following. A. Adjusted market assessment approach. An entity could evaluate the market in which it sells goods or services and estimate the price that a customer in that market would be willing to pay for those goods or services. That approach might also include referring to prices from the entity's competitors for similar goods or services and adjusting those prices as necessary to reflect the entity's costs and margins. B. Expected cost plus a margin approach. An entity could forecast its expected costs of satisfying a performance obligation and then add an appropriate margin for that good or service. C. Residual approach. An entity may estimate the standalone selling price by reference to the total transaction price less the sum of the observable standalone selling prices of other goods or services promised in the contract. However, an entity may use a residual approach to estimate, in accordance with paragraph 78, the standalone selling price of a good or service only if one of the following criteria is met. I. The entity sells the same good or service to different customers, at or near the same time, for a broad range of amounts, i.e. the selling price is highly variable because a representative standalone selling price is not discernible from past transactions or other observable evidence. Or 2. The entity has not yet established a price for that good or service and the good or service has not previously been sold on a standalone basis, i.e. the selling price is uncertain. A combination of methods may need to be used to estimate the standalone selling prices of the goods or services promised in the contract if two or more of those goods or services have highly variable or uncertain standalone selling prices. For example, an entity may use a residual approach to estimate the aggregate standalone selling price for those promised goods or services with highly variable or uncertain standalone selling prices and then use another method to estimate the standalone selling prices of the individual goods or services relative to that estimated aggregate standalone selling price determined by the residual approach. When an entity uses a combination of methods to estimate the standalone selling price of each promised good or service in the contract, the entity shall evaluate whether allocating the transaction price at those estimated standalone selling prices would be consistent with the allocation objective in paragraph 73 and the requirements for estimating standalone selling prices in paragraph 78. Allocation of a discount. 81A customer receives a discount for purchasing a bundle of goods or services if the sum of the standalone selling prices of those promised goods or services in the contract exceeds the promised consideration in a contract. Except when an entity has observable evidence in accordance with paragraph 82 that the entire discount relates to only one or more, but not all, performance obligations in a contract, the entity shall allocate a discount proportionately to all performance obligations in the contract. The proportionate allocation of the discount in those circumstances is a consequence of the entity allocating the transaction price to each performance obligation on the basis of the relative standalone selling prices of the underlying distinct goods or services. 82 An entity shall allocate a discount entirely to one or more, but not all, performance obligations in the contract if all of the following criteria are met. A. The entity regularly sells each distinct good or service, or each bundle of distinct goods or services, in the contract on a standalone basis. B. The entity also regularly sells on a standalone basis a bundle, or bundles, of some of those distinct goods or services at a discount to the standalone selling prices of the goods or services in each bundle. And C. The discount attributable to each bundle of goods or services described in paragraph 82b is substantially the same as the discount in the contract, and an analysis of the goods or services in each bundle provides observable evidence of the performance obligation, or performance obligations, to which the entire discount in the contract belongs. 83 If a discount is allocated entirely to one or more performance obligations in the contract in accordance with paragraph 82, an entity shall allocate the discount before using the residual approach to estimate the standalone selling price of a good or service in accordance with paragraph 79c. Allocation of variable consideration. 84 Variable consideration that is promised in a contract may be attributable to the entire contract or to a specific part of the contract, such as either of the following. A. One or more but not all performance obligations in the contract. For example, a bonus may be contingent on an entity transferring a promised good or service within a specified period of time. Or B. One or more but not all distinct goods or services promised in a series of distinct goods or services that forms part of a single performance obligation in accordance with paragraph 22b. For example, the consideration promised for the second year of a 2-year cleaning service contract will increase on the basis of movements in a specified inflation index. 85 An entity shall allocate a variable amount and subsequent changes to that amount entirely to a performance obligation or to a distinct good or service that forms part of a single performance obligation in accordance with paragraph 22b, if both of the following criteria are met. A. The terms of a variable payment relate specifically to the entity's efforts to satisfy the performance obligation or transfer the distinct good or service, or to a specific outcome from satisfying the performance obligation or transferring the distinct good or service. And B. Allocating the variable amount of consideration entirely to the performance obligation or the distinct good or service is consistent with the allocation objective in paragraph 73 when considering all of the performance obligations and payment terms in the contract. 86. The allocation requirements in paragraphs 73 to 83 shall be applied to allocate the remaining amount of the transaction price that does not meet the criteria in paragraph 85. Changes in the transaction price. 87. After contract inception, the transaction price can change for various reasons, including the resolution of uncertain events or other changes in circumstances that change the amount of consideration to which an entity expects to be entitled in exchange for the promised goods or services. 88. An entity shall allocate to the performance obligations in the contract any subsequent changes in the transaction price on the same basis as at contract inception. Consequently, an entity shall not reallocate the transaction price to reflect changes in standalone selling prices after contract inception. Amounts allocated to a satisfied performance obligation shall be recognized as revenue, or as a reduction of revenue, in the period in which the transaction price changes. 89. An entity shall allocate a change in the transaction price entirely to one or more, but not all, performance obligations or distinct goods or services promised in a series that forms part of a single performance obligation in accordance with paragraph 22b, only if the criteria in paragraph 85 on allocating variable consideration are met. 90. An entity shall account for a change in the transaction price that arises as a result of a contract modification in accordance with paragraphs 18 to 21. However, for a change in the transaction price that occurs after a contract modification, an entity shall apply paragraphs 87 to 89 to allocate the change in the transaction price in whichever of the following ways is applicable. A. An entity shall allocate the change in the transaction price to the performance obligations identified in the contract before the modification if, and to the extent that, the change in the transaction price is attributable to an amount of variable consideration promised before the modification and the modification is accounted for in accordance with paragraph 21a. B. In all other cases in which the modification was not accounted for as a separate contract in accordance with paragraph 20, an entity shall allocate the change in the transaction price to the performance obligations in the modified contract, i.e. the performance obligations that were unsatisfied or partially unsatisfied immediately after the modification. Contract costs. Incremental costs of obtaining a contract. 91. An entity shall recognize as an asset the incremental costs of obtaining a contract with a customer if the entity expects to recover those costs. 92. The incremental costs of obtaining a contract are those costs that an entity incurs to obtain a contract with a customer that it would not have incurred if the contract had not been obtained, for example, a sales commission. 93. Costs to obtain a contract that would have been incurred regardless of whether the contract was obtained shall be recognized as an expense when incurred, unless those costs are explicitly chargeable to the customer regardless of whether the contract is obtained. 94. As a practical expedient, an entity may recognize the incremental costs of obtaining a contract as an expense when incurred if the amortization period of the asset that the entity otherwise would have recognized is 1 year or less. Costs to fulfill a contract. 95. If the costs incurred in fulfilling a contract with a customer are not within the scope of another standard, for example, LKS 2 inventories, LKS 16 property, plant and equipment or LKS 38 intangible assets, an entity shall recognize an asset from the costs incurred to fulfill a contract only if those costs meet all of the following criteria. A. The costs relate directly to a contract or to an anticipated contract that the entity can specifically identify, for example, costs relating to services to be provided under renewal of an existing contract or costs of designing an asset to be transferred under a specific contract that has not yet been approved. B. The costs generate or enhance resources of the entity that will be used in satisfying, or in continuing to satisfy, performance obligations in the future. And C. The costs are expected to be recovered. 96. For costs incurred in fulfilling a contract with a customer that are within the scope of another standard, an entity shall account for those costs in accordance with those other standards. 97. Costs that relate directly to a contract, or a specific anticipated contract, include any of the following. A. Direct labor, for example, salaries and wages of employees who provide the promised services directly to the customer. B. Direct materials, for example, supplies used in providing the promised services to a customer. C. Allocations of costs that relate directly to the contract or to contract activities, for example, costs of contract management and supervision, insurance and depreciation of tools, equipment and right-of-use assets used in fulfilling the contract. D. Costs that are explicitly chargeable to the customer under the contract. And E. Other costs that are incurred only because an entity entered into the contract, for example, payments to subcontractors. 98. An entity shall recognize the following costs as expenses when incurred. A. General and administrative costs, unless those costs are explicitly chargeable to the customer under the contract, in which case an entity shall evaluate those costs in accordance with paragraph 97. B. Costs of wasted materials, labor or other resources to fulfill the contract that were not reflected in the price of the contract. C. Costs that relate to satisfied performance obligations or partially satisfied performance obligations in the contract, i.e. costs that relate to past performance. And D. Costs for which an entity cannot distinguish whether the costs relate to unsatisfied performance obligations or to satisfied performance obligations, or partially satisfied performance obligations. Amortization and impairment. 99. An asset recognized in accordance with paragraph 91 or 95 shall be amortized on a systematic basis that is consistent with the transfer to the customer of the goods or services to which the asset relates. The asset may relate to goods or services to be transferred under a specific anticipated contract, as described in paragraph 95a. 100. An entity shall update the amortization to reflect a significant change in the entity's expected timing of transfer to the customer of the goods or services to which the asset relates. Such a change shall be accounted for as a change in accounting estimate in accordance with LKS 8. 101. An entity shall recognize an impairment loss in profit or loss to the extent that the carrying amount of an asset recognized in accordance with paragraph 91 or 95 exceeds a. The remaining amount of consideration that the entity expects to receive in exchange for the goods or services to which the asset relates, less b. The costs that relate directly to providing those goods or services and that have not been recognized as expenses, see paragraph 97. 102. For the purposes of applying paragraph 101 to determine the amount of consideration that an entity expects to receive, an entity shall use the principles for determining the transaction price, except for the requirements in paragraphs 56 to 58 on constraining estimates of variable consideration, and adjust that amount to reflect the effects of the customer's credit risk. 103. Before an entity recognizes an impairment loss for an asset recognized in accordance with paragraph 91 or 95, the entity shall recognize any impairment loss for assets related to the contract that are recognized in accordance with another standard, for example, LKS 2, LKS 16 and LKS 38. After applying the impairment test in paragraph 101, an entity shall include the resulting carrying amount of the asset recognized in accordance with paragraph 91 or 95 in the carrying amount of the cash-generating unit to which it belongs for the purpose of applying LKS 36. Impairment of assets to that cash-generating unit. 104. An entity shall recognize in profit or loss a reversal of some or all of an impairment loss previously recognized in accordance with paragraph 101 when the impairment conditions no longer exist or have improved. The increased carrying amount of the asset shall not exceed the amount that would have been determined, net of amortization, if no impairment loss had been recognized previously. Presentation. 105. When either party to a contract has performed, an entity shall present the contract in the statement of financial position as a contract asset or a contract liability, depending on the relationship between the entity's performance and the customer's payment. An entity shall present any unconditional rights to consideration separately as a receivable. 106. If a customer pays consideration, or an entity has a right to an amount of consideration that is unconditional, i.e. a receivable, before the entity transfers a good or service to the customer, the entity shall present the contract as a contract liability when the payment is made or the payment is due, whichever is earlier. A contract liability is an entity's obligation to transfer goods or services to a customer for which the entity has received consideration, or an amount of consideration is due, from the customer. 107. If an entity performs by transferring goods or services to a customer before the customer pays consideration or before payment is due, the entity shall present the contract as a contract asset, excluding any amounts presented as a receivable. A contract asset is an entity's right to consideration in exchange for goods or services that the entity has transferred to a customer. An entity shall assess a contract asset for impairment in accordance with SLFRS 9. An impairment of a contract asset shall be measured, presented and disclosed on the same basis as a financial asset that is within the scope of SLFRS 9. See also paragraph 113b. 108. A receivable is an entity's right to consideration that is unconditional. A right to consideration is unconditional if only the passage of time is required before payment of that consideration is due. For example, an entity would recognize a receivable if it has a present right to payment even though that amount may be subject to refund in the future. An entity shall account for a receivable in accordance with SLFRS 9. Upon initial recognition of a receivable from a contract with a customer, any difference between the measurement of the receivable in accordance with SLFRS 9 and the corresponding amount of revenue recognized shall be presented as an expense, for example, as an impairment loss. 109 This standard uses the terms contract asset and contract liability, but does not prohibit an entity from using alternative descriptions in the statement of financial position for those items. If an entity uses an alternative description for a contract asset, the entity shall provide sufficient information for a user of the financial statements to distinguish between receivables and contract assets. Disclosure.